Hello everyone, this is Brooke, DeFi analyst from TID Research, and then today I'd like to talk about an interesting new protocol called msUSD. So msUSD is the issuer of the synthetic dollar called msUSD, and msUSD is backed by the on-chain option arbitrage strategies. So later we can talk about how the strategy works, but first I'd like to explain why I find this protocol interesting. First and foremost, the most straightforward reason is that the yield is actually pretty high. As a matter of fact, if you look at the list of all the major yield-bearing stable available in the market right now, you can see most of the other yield-bearing stable is earning like less than 10%. For example, for sUSDE, which is a base trading backed stablecoin issued by Istana, is earning 8.41% for this week. And for SERP USDC, issued by Maple, backed by the on-chain private credit loan, is earning like 9%. And then if we look at more exotic product with higher risk, for example, like the FXUSD stability pool token by FX Protocol is also only earning like 11%. You can get a feeling that right now the market environment is not very friendly to this kind of yield-bearing stable, because even though they all farm in different kind of yield, at the end of the day, the sources of their yields is actually the same. It's coming from the on-chain demand for leverage and also the trading volume and also the overall market sentiment. However, for msUSD, their strategy is the on-chain options arbitrage. It is actually a non-directional strategy. So this kind of strategy is actually very common in the traditional financial market. Option trader and most of the banks do this on a daily basis. So this strategy is actually non-directional and it's actually farming the volatility. And because options still quite a new asset class for most of the D traders, so I believe that the options in the DeFi market are definitely not efficiently priced, and therefore that's the reason why I believe there might be alpha within this option arbitrage strategy msUSD, and therefore I find it very interesting and might be promising. So let's first look into how the strategy works and why I call it the non-directional long volatility strategies. So the core strategies of msUSD MS is the options arbitrage. The essence of it is that they need to compare two things. The first one is the implied volatility. The second one is the realized volatility. So implied volatility is the market's expectation of the future volatility price into the options premium. So whenever you are buying or selling the options, you might notice that you need to either pay or receive an upfront premium. So that is called the price of options. As for how that price is calculated, is actually based on the volatility, because you are holding the options. So it means that as long as the price is higher than your strike price at the maturity date, you'll be making money. And so the chances of the price to go above the strike price depended on the implied volatility. The higher the implied volatility means that the chances of the price being higher than the strike price at maturity is also higher, and therefore the option tend to be more expensive. It is the same way for both options. The higher the implied volatility, the higher the price for the options. So it means that implied volatility is implied. So it's more of a market consensus about the future volatility. And then it's not always true that the implied volatility will be realized. And therefore, we need to look at another indicator called the realized volatility. It means that if I buy a call when that is very high, it means the market believes that they're going to be high going forward and there's going to be a lot of uncertainty. However, at the end of the day, if I buy an option with time to 3 months, after 1 month, the market is very quiet. The asset, for example, in this case, like a BTC or ETH, barely moves, and there's just no news at all, and then the price of assets just like trading within the very time. It means that the real volatility is actually very low, and then it means that the market will start to think maybe the chances of the underlying price to go above the strike price for the option I'm holding is not that huge, and therefore probably we might not want to spend so much money to trade these options. And therefore, in this case, it means that the realized volatility is actually smaller than the implied volatility. And therefore, the option price will start to decrease and then will later reach a new implied volatility that price in the lower realized volatility that has already happened and then being priced into the price. So that's the comparison between the implied volatility and the realized volatility. And these are the two most important concepts when you're trading options. However, you might think about it. If you have a strong view on the relationship between implied volatility and the realized volatility, how can you trade this? And the answer is that you can use the option arbitrage strategies, which is exactly what MainStreet is doing here. So what MainStreet is doing is that when they believe that the implied volatility right now is too high, they will sell straddle. They will sell the straddle, which means that they will sell one call option and a put option and the money. It means that when the position is first formed, is delta neutral, and they are able to collect premium. If the price starts to move, and then it means that the position is no longer neutral, they will either buy or sell the online spot to keep it as neutral. By doing so, the whole position will remain delta neutral, and they only need to wait till the volatility drop below the implied volatility, the realized volatility to drop below the implied volatility. When they first purchase the option, then they can buy back the straddle and therefore unwind their position. And their whole profit, their profit will be the spread between the premium they first receive and the premium they later pay to unwind the position. So this is the short volatility strategies. And the long volatility strategies works exactly the opposite. So if they believe that right now the implied volatility is just too low, and they believe that the realized volatility going forward will be much higher, they just long straddle. And then if the price move, they just buy or sell the online spot to hedge away the additional delta. And then if the realized volatility indeed increase and therefore push up the implied volatility, they just sell their long straddle options and then to realize their profit. So this is how the whole strategies works. And then you might be thinking, it's not a directional trade on the online price, but it's actually a directional trade on the online volatility. However, if you think about it, because it's going to be delta neutral, so no matter how the price move, they can always wait until the condition they are looking for realize and therefore unwind the strategies. And that is one of the advantage of this setup. And the second advantage of this setup is that the gamma, which is the second derivative of the options value against the online asset price, called gamma. Gamma is also working in the benefit of this strategy. So when you short volatility strategies, you are also shorting gamma. However, when you short gamma, you can see that they collect the premium upfront. So they can always stop loss. The point when they need to stop is when they realize that when they're adjusting their delta neutral position, when they're rebalancing, they always need to pay some price to offset the gamma. That's the price they need to pay when rebalancing while shorting the gamma. So that's the price they need to pay. However, if they realize that the price they're paying is too high to rebalance, and then they're also seeing that the volatility is actually getting higher, they can just unwind. And the cost of the unwind will be the premium they collected earlier minus the premium they pay later, and also minus the cost they rebalance. It means that when they're shorting gamma, they still have more visibility under their control, and they can always call a stop to the whole position. However, when they're long volatility, even though they're not receiving any premium, as a matter of fact, they need to pay a premium upfront, but they are long gamma. So it means that no matter how the price moves, they're always making money when rebalancing the position. So even though they pay the premium upfront, as long as the price starts, they are able to earn something to offset the cost. And then even if later on they believe that the trade is no longer profitable, they can unwind proceeds from the gamma, will always help to either compensate or add on the P&L they've made. So that is the reason why the strategy is very good for MainStreet. And on top of that, we also have to bear in mind that in the crypto market, the volatility is often much larger than the traditional financial market like equities. Therefore, it's fairly easy, as long as you keep your margin safe with enough collateral, it's fairly easy for you to choose your end exit point. And on top of that, because the option is not so frequently traded in the crypto market, it means that it's not always efficiently priced. It means that there's always some kind of alpha. For example, they believe that the implied volatility is lower than the realized volatility. So if in the traditional market, it's more of a divergence of views. So even if the implied volatility is lower than the realized volatility, and then some other people might believe that it's not the case. So it's more of like divergence of views. However, in the crypto market, it might just be the case that it's really lower than the realized volatility. And the reason why that is the case because no one is trading options. So what they're doing is they're trying to shore up the role as an option market maker that is very commonly seen in financial market because no one is doing that. So if you look at the option market, you rarely hear any institutional players. You rarely hear any like big KOLs or whales trading options, and that is exactly why the strategy can be good for Main Street. So because the market is so inefficient, the alpha can be very easily found, and the bar to break even or make profit is relatively low. So there's a whole strategy about the Main Streets, and then we can also look at its performance. So right now the APY is like 24%, and then we can look at that dashboard. And then the msUSD supply is still relatively small, but it's increasing. And then we saw a large redemption a few days ago, but overall still in the upward trend. And APY you can see it's actually pretty sustainable. So ever since the inception, it's like 24%. And then during the period of time when the volatility is like crazy, it once reached a level right 29%. But even right now, the market is cooling down a little bit. The APY is still like 24%. So again, like much higher than all of its pairs. And then showing that there's indeed alpha for such option player in the DeFi market, because not a lot of people are interested in options. And security-wise, Main Street is audited, and they have this attestation dashboard for you to review their position. However, I think the most important risk warning is that even though everything seems to be very transparent and then there's audited done, however, the strategy itself can still backfire. It's not because of is there any system error or there's any smart contract risk, but because that there's still a chance the market just not work in the way the team expected it to work. If it work in the opposite way, in a very, very radical manner, there's still a chance for the strategy to lose money. And overall, so far, it looks like a decent project, good collateral ratio, good APY, good growth trend, and a good disclosure. And that's the reason why I believe it's a very, very interesting protocol.